In this video, we'll discuss the differences between exercising a contract and being assigned. These two words can be a little bit confusing for a lot of newer option traders, but understanding who can exercise a contract and when, as well as who's at risk of being assigned, can help you better manage risk as the expiration date approaches. So to keep you safe and up to speed on the terminology, let's dive in. Okay, let's talk exercising your position. So the first thing to take note of here is that buyers are the ones who exercise. So just keep note of that and keep those two things in your head. So buyers of contracts will exercise the position. So a call or put buyer has the right to exercise, or in other words, convert their option position into a stock position at the option strike price at expiration. So what does this look like? Let's break it down into a little scenario. So here's a call scenario. Let's say that you own a call at a $250 strike price. And let's say that the underlying stock price goes up to $260. That's what we want, right? So that's a good thing. We bought a contract with a strike price of $250, expecting the stock to go up, and it does. It goes up to $260. Now, at expiration, you have the option, but not the obligation, to convert, or in other words, exercise your call contract into 100 shares, or buy the shares at the strike price of $250. So you locked in this price of $250 when you bought the option contract, and now when the stock price goes up to $260, you can actually buy those shares at this $250 price. And the reason why you would have 100 shares is because, as a little refresher, each option contract is worth 100 shares. So if you exercise that one contract, you would end up with 100 shares at your strike price. So now you would own 100 shares of stock XYZ at $250, even though the stock price is at $260. Which is good, because then if you actually sold those shares at the current price that the stock was sitting at, you would make money off of it. Now let's look at a put scenario. So let's say that you own a put at $250 and the underlying stock goes down to $240. That's what we want, right? We bought a put position at $250, anticipating that the stock price would go down, and it does. It goes down $10 to $240. Now at expiration, you have the option, but again, not the obligation. You do not have to exercise your position, because let me just give you a little note. Most people who are trading options are actually just selling and getting out of the option contract. They're not converting them into shares, but you do have the option to convert them into shares, or in other words, exercise your contract. And this put would become 100 shares, and it would be a sell position because puts are short. So you would have 100 shares in a sold position at the strike price of $250. So you are now short 100 shares of XYZ stock at $250, which is the strike price that you purchase these put contracts at, even though the stock itself is at $240. So now you're short the position at $250, the stock price is at $240, you would have these shares, and if you bought back the position to get out of it, so you would close a short position and on the equity side, you would actually make money off of it. So if the buyers are on the exercise side of things, then the sellers must be on the assignment side of things. So keep those two words in mind and keep them together. Sellers are with assignment, and previously it was buyers are with exercise. So if you are a call or put seller, you're at risk of assignment when a buyer exercises their option. Let's look at a scenario. So let's say that you short a call at the $250 strike price. So you've sold a call at $250. When we sell calls, we don't want the stock to go up. We don't care if it really goes down. We just don't want it to go past the strike price. It could hang out around here. It could go down. It could do whatever it wants, but we really don't want the stock to go above $250. So we've sold this $250 strike price. But now, unfortunately, let's say the stock does go up to $260. So now the stock is up here. It's gone up to $260. At expiration, the buyer of that call exercises their option into 100 shares. So they buy the position and now they're long. So remember previously we had a scenario where someone had a strike price here and then the stock went up, right? And they decided to exercise their position and now they have 100 shares of it. So they bought those shares at the strike price of $250. The short seller, or the person that sold that call, is now assigned at random and must sell 100 shares to the buyer. So on every side of a transaction, there is a buyer and there's a seller. So if someone is long these option contracts and they decide to exercise their position and buy 100 shares, then the person who is shorting these call contracts is on the other side of it and at risk of assignment to then sell them 100 shares. And if that happens, then the person who sold the option contract at the $250 strike price, or in other words, the short seller, they're now short 100 shares of XYZ stock at $250, even though the stock price is at $260. So they entered into an option position at 250 strike price, expecting the price of the stock not to go up. But when the price of the stock actually went up and they got assigned, they're now short at $250, even though the stock price is at $260. So if they were then to have these shares short and they tried to get out of the position and they had to buy back the shares, they would be buying back the shares at a higher price and actually be down on the position. And let's go ahead and look at a put scenario. So let's say that you sell a put or you're short a put at the $250 strike price. Now you're expecting again that you're selling or shorting this put at $250, not expecting it to go down any further. But unfortunately, the underlying stock decides to go down to $240. So now at expiration, the buyer of the put decides to exercise their option into 100 shares or a sold position at the strike price of $250. The person who sold the put, or in other words, the short seller of the put, is then assigned, again at random, and must buy 100 shares from that seller. So again, there needs to be someone on both sides. So if you've got someone who bought into a long put position, exercised that position into shares, and now is short the position, there needs to be a buyer on the other side. So the person who sold these puts, when they get assigned, they are now long 100 shares of XYZ stock at 250, even though the stock price is at 240. So they are long here, even though the stock price is down here. So unfortunately, it seems like the seller is not making out okay in these scenarios. Let's put it side by side so you can just see the difference between the two. So let's say that Sally buys one option contract for Apple at a strike price of $100. So here we've got Sally buying a strike price of $100. Now, at expiration, Apple is now at $110, so it's gone up. She's bought a call and the price went up and she's happy. Sally decides that she actually wants the shares of it, so she exercises her right to buy 100 shares via her one contract of Apple at 100. So she's able to buy her Apple shares at $100, even though the price of the stock is currently at $110. But Sally now owns 100 shares of Apple at 100. So if tomorrow she decided to sell those shares at the current stock price of 110, she would make money off of it. Now, Billy, on the other hand, on the same day that Sally decided to buy an option contract, Billy decided he was going to short an option contract or sell an option contract for Apple at the same strike price of $100. Now, at expiration, Apple is at 110, right? So it went up that week. When Sally exercises her right to buy 100 shares of Apple at $100, Billy must now sell her those shares. So Billy, unfortunately, is now short 100 shares of Apple at $100, even though the stock price itself is at 110. So unfortunately, Billy is in a losing situation here, and Sally is having a good day. So remember, Sally is a buyer, so she gets to exercise her position if she wants to, and Billy is a seller, and he's at risk of assignment if the stock goes against him. Let's take a look at just a few additional notes to make sure that we've covered everything. So again, buyers, they can exercise their position. They don't have to, but they can. Now, if you are a buyer and your position is in the money, so you're long a call or long a put, or you bought them, right? These contracts will automatically be exercised at expiration. So after the close on the expiration date, if you do not close them, if they are in the money, they will automatically be exercised and you will wake up with shares in your account. Now, if your contract is out of the money, so you went long on a position, but it never got to where you needed it to go, then if you don't close that, it will just expire worthless. On the other side of things, sellers who again can be assigned, if the short options or the sold calls or sold puts are in the money at expiration, they'll automatically be assigned. So if they go into the close and the day ends and they're in the money, they will automatically be assigned. It's important to take note that early assignment can happen, and it can happen whenever a contract enters in the money before expiration. Although the further from the expiration date we are, the less likely you are to be assigned. But 2 days before expiration, early assignment risk becomes a lot greater, because that's when more people on the long call, long put side begin exercising their position. If the calls and puts that you sold are out of the money at expiration, they will expire worthless and the full premium can be collected. But one very important thing to take note of is that changes in the stock price after hours can affect a last minute change from out of the money to in the money. So let's say at the end of the day, you have a strike price of $105. But the stock itself closes at $102. So your contracts are out of the money on the day of expiration. Remember, they're at 105 and you were in a long call scenario, but the stock itself closes at 102 on the day that it expires. So again, your contracts, they're out of the money. So you're not worried about it. Maybe you just shut your computer down and you go about your day. But let's say this stock has some crazy news in the after hours and it spikes up and now it's at, $110. You're now in the money. But unfortunately, option contracts cannot be managed in the after hours or the pre-market. Same thing for if you sell a call or a put. It's the end of the day, it's looking like it's going to expire worthless, so you just shut it down, you go home, you say, I've collected all this premium. But then again, something crazy happens, and all of a sudden, those contracts are now in the money, and you get assigned into a position that you really don't want to be in. So it's advised that all positions are closed manually prior to expiration to avoid any after-hour change in the stock price. Remember, it is better safe than sorry. So one last thing, just to hammer it home for you guys, buyers can exercise a position and sellers are at risk of assignment. You should now have a better understanding of the differences between exercising a position and being assigned. Remember that it's always important to manage your option positions as the expiration date approaches. Trade safe and follow along for more videos like this.